I don't know what you call it. I call it good cop, bad cop. I think both messages have validity. I think we're closer to Larry's message than we are to the president's, but he is in campaign mode. I will say that I think China, having slowed this year after tightening last year, now easing this year, I think we're going to start to see some growth coming out of China in 2019. I think that's going to be good for a lot of the names that many of us hold in our portfolios. And I do think that they're going to crack down on capital flight. And so the Macau casino names should be something that we should be watching. But the trade war is going to be with us for a long time. And I think the market, I didn't trust the futures this morning, at 3 a.m. West Coast time. I didn't think it was going to sustain, and I don't think we're going to get an easy tweeted out response to this whole mess.
Well, if you believe that, Nancy, what do? Let's say you're somebody who thinks the trade war is going to escalate for 2 or 3 years, 5 years. How do you invest around it? How do you make money off it?
Well, I mean, one of the ways is the consumer. Look, we got those great wage numbers today. Great if you're a consumer discretionary or consumer staple. Not so great if you're an interest rate sensitive holding or security like the banks. And so, we like a lot of the consumer names. So we've been adding to things. We jumped in ahead of earnings. We never do that, but we sold out of eBay. I think I told you that a few weeks ago. We're going to upgrade the quality of our portfolio. We sold out of eBay and we bought into Starbucks. We already own Starbucks. We like Walmart. We like Costco at these levels. So there's a lot of places, McDonald's, Home Depot. There's a lot of ways to play around the edges. But yeah, I mean, rising interest rates, the market has to adjust. We're not at historic highs. This isn't, these aren't levels that are going to shut down price multiple expansion, but the market's recalibrating and it takes some time.
So, Mark, if you add it up, I mean, we actually had a fairly good week for stocks overall, 2%, 2.5% gains across the major averages. Best week for a lot of them in months. What does that tell you, that sort of bounce back after the October that we had? Was it just due for a bounce, or has sentiment shifted?
Well, Sarah, I think it's a little bit more the former than the latter, but it's encouraging nonetheless. Obviously, we would like to think that we've found a durable bottom here at this juncture. I'm not so sure that we have. It's very typical from very oversold readings that we had coming into this week that you would at least get some kind of a reversal of that sentiment, which was so poor, at least for some days. And it was encouraging, actually, even though we closed down today, to see us close at a level that didn't take back the gains that we've accumulated over the last couple of days before investors kind of closed up their books going long into the weekend. So I'd say that's certainly, again, a welcome sign at this juncture. However, I don't know that we've necessarily passed the point at which this corrective process has fully flushed out the levels that we're likely to get to before we can resume a more sustainable advance. That said, I do think it's no more than a correction as opposed to something that may metastasize into something more sinister, read a bear market, because the fundamentals, some of which were mentioned earlier, are too strong relative to macroeconomic conditions domestically at least, and the support for them by way of the consumer spending and job gains we've had.